dive right in. Today, we're tackling something that is, and I'm not exaggerating here, the absolute bedrock of modern investing. It's an idea that completely changed the game for pretty much everyone who deals with money. We're talking about portfolio theory.
It all starts with this one question, doesn't it? It's the question every single one of us is asked. You want your money to work for you, to grow into something more, but you also want to be able to sleep at night without worrying you'll lose it all. So, what's the secret?
And the answer, or at least the smartest one we've got, is this incredible idea, portfolio theory. It's not about finding that one-in-a-million stock pick. It's about building a solid, smart, and resilient system for your investments, one that can handle the ups and downs.
And all of this, really, it all boils down to one fundamental challenge. The one question that's at the very heart of what it means to be an investor.
It's the classic trade-off, isn't it? The name of the game. If you want a shot at those huge returns, you've got to be willing to accept the chance of bigger losses. But here's the key. That balance is different for everyone. Your comfort level with risk is totally personal, and portfolio theory is the map that helps you navigate it.
Okay, but to make really smart choices, we can't just go with a gut feeling. We need a way to actually measure these concepts, to put a number on risk and reward.
First up is something called expected return. Now, don't let the fancy name fool you. All it really is a weighted average. You just look at all the possible things that could happen, the good, the bad, the okay, and you weigh each of those outcomes by how likely it is to actually happen. That's it.
And here's what that looks like in practice. We imagine a few different versions of the future economy, right? And we give each one a probability. Then we just estimate how our stocks would do in each case. And just look at stock B. It's got that huge potential for a 50% gain, but it's also got that scary chance of a 10% loss.
So, you run the numbers for our steadier option, stock A. You multiply each possible return by its probability, you add them all up, and what do you get? 12.5%. Now, this isn't a guarantee, of course. Think of it as our single best, most rational guess for what that investment might give you over time. But remember that 12.5% is just the average. The real result could be higher, or it could be lower. And that's where risk enters the picture. The tool we use to measure it is called standard deviation. And all you need to remember is this. A higher standard deviation means a wider, more unpredictable range of outcomes. It's a wilder ride. It means more risk.
Okay, so we can measure risk. That's great, but how do we manage it? Well, the answer is probably the single most powerful tool an investor has: diversification. Think of it like this. You wouldn't build a basketball team with 5-star point guards, right? You need a balanced roster to win. It's the same idea.
I mean, we've all heard the saying a million times, right? Don't put all your eggs in one basket. Well, this is just the fancy, official finance version of that exact same wisdom. It's all about mixing things up.
And this is where it gets really, really cool, because this shows us exactly why diversification works so well. It turns out there are two kinds of risk. There's unsystematic risk, which is like a single leaky boat. It only affects one company. If you own a whole fleet of boats, one little leak won't sink you. You can get rid of that risk. But then there's systematic risk. That's like a rising tide that lifts or lowers all the boats. It's the whole market, and there's nowhere to hide from it. So how do you actually do this? Well, it's pretty straightforward. 3 main tactics. 1, you spread your money across different types of assets like stocks and bonds. 2, you mix in investments with different risk levels. And 3, you don't just invest in one industry or one country. You go global. And here it is, the big aha moment. Since we can get rid of that company-specific, unsystematic risk just by diversifying, basically for free, the only risk the market actually has to pay you to take is that systematic, rising tide risk. So the question is, how much should you get paid for it? We need a way to put a price on that risk. And this is it, the capital asset pricing model, or just CAPM for short. Now, it sounds super complicated, I know, but the idea is actually beautiful in its simplicity. It's a formula that tells you what return you should demand from an investment based on how much of that non-diversifiable market risk it carries.
And the secret ingredient, the key that makes the whole CAPM equation work, is a little something called beta. Just think of beta as a risk score. It tells you exactly how sensitive a stock is to the movements of the overall market. It puts a number on that systematic risk.
And looking at it this way makes it super intuitive. By definition, the market as a whole has a beta of exactly 1. So a stock with a beta of less than 1, like a boring but stable utility company, is less volatile than the market. And a stock with a beta over 1, like a high-flying tech startup, is more volatile.
If the market goes up 10%, that tech stock is expected to jump 18%.
Okay, so we have these amazing tools to measure risk and to figure out what a fair return should be, which of course leads to the million-dollar question. Literally. With all this knowledge, can you actually go out there, find those hidden gems, and consistently beat the market?
Well, there's a very powerful, very famous theory that says, probably not, at least not easily. It's called the efficient market hypothesis, and it basically argues that a stock's price at any given moment already reflects all the information out there about it. In a way, the game is already fair.
And this theory comes in 3 different strengths. Weak form says you can't get an edge just by looking at old price charts. Then there's semi-strong form, which says that even analyzing all the public news and financial reports won't help you. And finally, strong form, which most people think is a stretch, says that even insider information is already baked into the price.
But hang on a second. Let's think about that first one again. If the market is just weak form efficient, which, by the way, most of the evidence says it is, what does that mean? It means the entire industry of technical analysis, of trying to predict the future by looking at charts of the past, is basically useless. That is a huge, huge implication.
So let's put it all together. What's your new investing toolkit based on everything we've talked about? Well, first, you've got to know yourself and find your own personal balance between risk and reward. Second, diversify, diversify, diversify. Get rid of that risk you don't get paid for. Third, use beta to understand the market risk you are getting paid to take. And finally, have a little humility. Markets are really, really good at what they do.
You know, in the end, portfolio theory gives us this amazing framework for thinking rationally and smartly about our money. It's not some get-rich-quick scheme. It's a set of tools to help you build a smarter, stronger financial future. The theory itself is crystal clear. The only real question left is, what kind of investor are you going to be?